principles, it seems, you know.
If you decide to go out and buy bonds from the bank, for example, you could go out and buy, you know, a bond. You could go to the newspaper, for example, and you open up the financial papers, the business paper, let's say the Globe and Mail or the Toronto Star. You can go to the business section and you go and you look up the different bond prices. What are you buying when you're buying a bond?
Why?
What? Not why, but what?
What is bond?
What is a bond? That's it. That's what I'm asking you. You know? Don't ask me. I'm asking you. Gotta look it up in the dictionary here. You know, Mr. Frank over there. What's a bond all about? If you buy, I mean, you could buy. Let's say you could buy Microsoft bonds. You could buy bonds for Dominion supermarket or Subway restaurants, for example. You could buy bonds. Oh, now he knows, you see. You know? Okay, Julie, what's a bond?
Borrow money?
Well, basically what you are doing is you are buying somebody else's debt, if that makes any sense. Okay, so a bond is basically buying debt. So for example, if a company wanted to expand their production, they may go hugely in debt, and so the bond will basically say, we promise to pay Professor Scoggins his $1,000 that he has invested in our bond plus 10% interest. And by doing so, you are basically helping the company to get out of debt. But of course, one day, the company has to pay the individual back. Now, treasury bills are quite similar, but they basically are government bonds. So, for example, when Hong Kong decided to expand their airport, they issued a bond. Okay, they issued a bond and said, okay, we would like to build a new airport. Who is going to help us to build this airport? And we will enable you to share in the investment of the airport, and you will make profit from the airport as well. So the Hong Kong government issued bonds, and they said, okay, we are prepared to give you, let's say, 4% interest over a period of 10 years, which would be the length of time that it will take to make the airport. Now, before I came here in Toronto, I was living in Istanbul, and Istanbul had just built a new subway system. And Istanbul did not have the money to build a new subway system, and so they had to issue a bond. And it was a treasury bill that you could say, okay, who would like to invest in the Istanbul subway system? And by doing so, you would be able to make a profit and at the same time help Istanbul to build their subway system. When Canada went to war, okay, during World War II, okay, or even when Canada sent soldiers to Korea in the 1950s, you probably have forgotten the fact that Canada have many dead soldiers on your soil, you see. You know?
No, we'll never forget that.
That basically a lot of Canadians died to sort of defend Korea, and for that reason, Canada issued bonds. These were called war bonds. And assuming that we win, okay, because if you lose, you don't get your money back. For example, Germany during World War II issued war bonds, and Germany, as we all know, lost the war. And therefore, everybody who invested in German war bonds lost their money. So assuming that we win the war, you know, you will get your money back plus interest. Okay? And in those days, it was seen as your patriotic duty to go and to give money to Canada during the war. So ladies used to take off their wedding ring, and they would take their jewelry and they would sell their jewelry so that they could buy war bonds to help Canada to liberate Germany from fascism, for example, during World War II. Okay, so a treasury bill is essentially a government bond, which means that you are buying somebody else's debt. Okay, and in the case of a treasury bill, you're buying government's debt, but if you're buying a bond, you are buying company debt. And it could be any company. You just need to look at the newspaper. Maybe today when you finish school, go and buy the newspaper, the Toronto Star, or you can buy the Globe and Mail, and go to the business section, and then you open up the business section and you will see all the stock exchange, the Toronto Stock Exchange. There's also the listing of the New York Stock Exchange as well. And you will see the bond market, and the bond market is there that you can, look at the different prices, and you will see the various interest rates. Now, on the whole, we could argue that the bond market is very low risk. Okay, it's not very risky to invest in bonds. The only possibility that you will lose your money is if the company goes bankrupt. Okay, and you lose your money. But it's not very likely that the company will go bankrupt, but it's possible. Okay, Enron was the biggest, I think the book said yesterday that it was the 7th largest company in the United States, and it went bankrupt. So all the bonds that you bought from Enron suddenly became worthless. Okay? Now, a government bond, a treasury bill, if the country goes bankrupt, then you will lose the money as well. And not only if it goes bankrupt, but if it fails to repay its debts on time. So if the World Bank says, okay, you owe us $1 billion a month, and you say, sorry, we don't have any money this month, the moment that happens, suddenly all the government bonds become worthless. And this happened in Korea about 14 years ago when you had the financial crisis in Korea. It also happened in Argentina, okay, about 10 years ago, that suddenly there was no money available. Okay? And basically they said, sorry, you have lost all the bonds. But other than that, which is quite unlikely, it doesn't happen very often, you are pretty secure, okay, with a bond. But the problem is with bonds is that the rate of interest is relatively low. So the sort of people who buy bonds are old geezers like me, okay, an old man like me who is very worried about any form of risk, because I am coming close to my retirement and I don't want to lose the possibility of all my money, all my retirement money. So probably I will not be investing in mining shares, which are very risky. You might, discover diamonds, but you probably won't. Or if you're looking for oil, you could spend millions of dollars looking for oil and you don't find anything at all. So for that reason, it's a very risky type of business. You might suddenly become incredibly rich, okay, or you will lose all your money. So people maybe like Hamina, for example, who is 18 years old, she could feel, hey, no problem, I've got a lot of time left. Okay, I've got a lot of time left, and therefore I don't mind spending all my money and maybe becoming rich or maybe becoming really, really poor. For her, risk is okay. But people like me, we enjoy our sleep. We want to sleep at night. Hamina never sleeps. That's why she's so dozy during the daytime, you see, because she's always having parties and discos and that type of thing, nightclubs that she's always going to all night long, you see. So for her, sleep is not important, you see. But for me, if you take away my sleep, I get very grumpy the next day, So for that reason, we tend to be very risk averse, and people like Hamina tend to be very high risk takers. So the sort of investments that she would choose would be very different from the type of investments that I would choose. Okay, so basically that is the bond market. Okay, the next one is the commodity futures. Okay, commodity futures. Commodity futures. Who can tell me what the commodity futures market is? If you look on the newspaper right next to the stock exchange and right next to the bond market, you suddenly find the futures market. It's the third one that people talk about. And there's lots of different choices in the commodity futures market. You can choose coffee, which is the largest of all the commodity futures. Brazil has now entered the orange juice market in a big way. They now have super tankers, if you can believe that, which you would think that they would put oil in, but in fact they put orange juice into super tankers now. And they are now flooding the market in the United States with relatively inexpensive orange juice. So you can buy orange juice commodity futures. A good friend of mine in Toronto who owns a pension fund, who is a pension fund manager, he actually bought pork bellies, okay, the stomach of pigs, okay, and you can buy pork belly futures as an investment. And as the word would suggest, you are buying something for the future. Okay, so if you are deciding, okay, I'm going to buy coffee futures, why would you buy the commodity futures? So let's say what you're doing is you're saying, okay, I'm going to buy 1 million kilos of coffee, and I want you to deliver that coffee in 2 years' time. So they say, oh, okay, so now you own, let's say 1 million kilos of coffee, which will be delivered in 2 years' time. Now, there is no way that you're going to allow, thousands of kilos or millions of kilos to be delivered by a big truck or an airplane to your house, because there is no way you can use that type of coffee. But what you're going to do is that just before, the day before delivery takes place, you are going to resell that coffee, hopefully to make a profit. So you're speculating on the price of coffee. And some people feel that commodity futures are very immoral, not moral, immoral, because commodity futures traders are praying for a disaster. They are hoping that there will be, frost in Brazil, that there will be snow and thunder in Brazil, which will kill all the coffee trees. Because we know by the law of supply that if you look price quantity here, and you look at, let's say, the price of coffee, so this is the price of coffee, let's say, let's say it's $5 per kg, for 1 kg. What's going to happen? What's going to happen when there is less supply? If suddenly half the trees in Brazil suddenly die,
The price will go.
well, you're going to find that the supply will decrease. This is S1. Supply will decrease. Okay, so now you only have, let's say, 0.5 of a kilo left. You've had a reduction, and this is going to force the price up to, let's say, 8 kilos. Okay, $8, I should say. So suddenly, because of the shortage of coffee, the prices have gone up, and this basically means that you will have made a speculative profit. Okay? So commodity futures market are praying for shortages. They're praying for a disaster. They're hoping, if you buy pork belly futures, you're hoping that there will be some disease that will spread throughout the pig population, that all the pigs will die of AIDS or something like that, and that there will be a shortage of pigs, and the pigs that exist will be extremely valuable. So just before taking delivery of, let's say, 1 million kilos of pork, or pork bellies they're called, that they will resell them on the market, hoping by that time, in 2 years' time, that the price has gone up and you will make a profit. Now, of all the investments, I can personally say this is the most risky, okay? Because what happens if suddenly the weather is wonderful in Brazil and there's a bumper crop of oranges in Brazil? You're in big trouble. Because suddenly the price goes down. Why? Because we know that if the supply goes up, okay, which is represented by a rightward shift in the supply curve, that suddenly the price has now gone down. So an increase in supply will drop the price. Now you've got, let's say, coffee that you paid $5 a kg for, which is now only worth $3 a kg, and you bought 1 million kgs of the stuff. Just imagine how much money you have lost. You've lost $2 million, just like that. So this is only for the people who are very hardened, you might say, people who don't mind not sleeping at all for the next 6 months because you're really going to be worrying about that type of investment. It could happen that you'll be a millionaire and you'll be rich and you'll be, and if you don't mind losing the money, I suppose you can go into that sort of thing, but, most people would worry too much about that type of investment. But it's big business, okay? And you can sort of, you can see that in the newspapers. You can go and you can sort of see, you can see the different possibilities. There's at least 100 commodities that you can go on to. Now the obvious question would be, why would a farmer be willing to sell their coffee in advance of the harvest? And the only answer that we can give is that a lot of farmers are very worried about the instability of prices. Okay, one of the disadvantages of the free market is that the markets generally in agricultural produce is very volatile. Okay, the word volatile means it's going up and down and up and down and up and down. And you will find that farmers don't like that volatility. They prefer a bit of stability in the market. And for that reason, a lot of farmers are very happy to sell their future crop for a future price. That they know that before they even plant their crops, they know that they have a guaranteed price. Now maybe, of course, if the price suddenly goes dramatically up, they're going to feel disappointed because they could have had even a higher market price. So they're taking a risk as well. They are taking a risk that maybe the price will go up so high that the price that they sold it for was actually under the world market price. But at the same time, because of the increase in production of coffee, you may find the price start to tumble, but the buyer is guaranteed to pay that high price. He is sworn to pay, let's say, $5 a kg in the year 2009. Okay? And no matter what happens, he has to pay that price. Even if the real price of coffee is only $1 a kg, he has to pay that farmer $5 a kg. So what is that giving to the producer? Well, it's giving something very valuable, and that is stability. And it's something which a lot of people feel benefits the market, is the idea of buying things in the futures. But as I say, I would only advise it, okay, on terms that people understand the risk, that they realize that this is not a guaranteed option. Okay, what I would like you to do in your notes, I just want you to make a little chart here. Okay, and you can sort of have, let's say, advantages over here, or maybe, let's have advantages over here and disadvantages over there. Okay, and then just put the sort of the commodity futures. Okay, so here we're going to have one for the buyer, because both are different. Okay, so the buyer is here, and then the seller, or the farmer, is there. Okay, so you should be able to have, I suppose, 2 for each. So have 2 there, and 2 here. Okay?